Hello to you all, welcome to the fourth lesson of the introduction to the option market. So in this case, we are going to learn about the trade management of an option. We are going to learn how to manage the strategy before, during and after their expiration. Okay, have the agenda, how to manage them prior to the expiration, at the expiration and overall. How to manage the option prior to the expiration. First, we'll have to look at the outlook. Are you still going to have the same view of the security? Does something change? Were you bullish and now you are neutral, bearish? Something change, some fundamentals change, some new political stuff or something like that? Did your time horizon change? At the same time, from your point of view as a trader, you have to be honest with yourself, and when you are doing the reevaluation and you already have a trade going, you should not fall into the trap of making adjustments without considering the end objective of the trade. So, what factors affect the premium? First is the moneyness. So, out of the money options offer lower premiums and lower probability, while at the money options have the most time value. The time to expiration, nearer term expiration offer the potential for the highest annualized return but a lower upfront premium, while the longer dated expiration decay at a slower rate but have higher premiums. And the expected movement from the underlying, in this case the implied volatility. Don't worry, we are going to speak about this one in the next lesson as well, and also in the advanced one in full details, because it's the most important factor that we have from the options. So in this case, a higher implied volatility is going to give us bigger prices for the premiums, while a lower price for the volatility, while a lower implied volatility is going to give us a lower value for the premiums. So we have three ways to manage the strategy. We can leave it just like it is, we can close it, or we can, adjust the strategy by reducing the position, rolling it up, down, or out. When we leave the strategy, we can exercise it and assign it, or we can just stay in it. And if we are going to close the strategy, we are going to trade out entirely of the strategy. So, if we are going to do an early exercise, it's going to make sense when you cannot sell the option in the open market for at least intrinsic value, and typically the option is either very, very deep in the money, close to expiration, or both. For example, you are long an ABC call expiring this Friday with a strike of 100. Right now the ABC is at 105. So in this case, you are going to sell the ABC contract for 450, and in this case, because so you are going to sell it for 450, but because you exercise your option to buy ABC at 100 and then sell the stock at the open market for 105, you'd receive the $5 difference. But if you sold this contract, you will receive only 450, minus, of course, minus the premium paid. So yeah, this should be one difference. But yeah, in this case, a hypothetical scenario that is going to finish with 105, but imagine it's finished with 103 on 5 or whatsoever. When you are going to sell it, this 450 is going to be finished, it's going to be final. But this value, it can go upwards or downwards. So yeah. So when you have an early assignment, the less time until the expiration, the greater the risk. And this is for the short time obligation. The deeper in the money, the option, the greater the risk. And as well, the early assignment also frequently occurs around dividends, so pay special attention. Example, when the underlying pays a dividend, calls have a higher assignment risk. Why? Because the option may be at or slightly in the money and only trading for 20 cents of the premium, when the underlying is paying 50 dividend cents for the premium, for the dividend. So if you are planning on owning the stock, it would make more sense to exercise the option just prior to the ex-dividend so that you would receive the dividend as well. But yeah, these are more complex parameters, but yeah. Now, prior to the expiration, what is a rolling? So in this case, with the rolling, it's placing one trade to simultaneously close out a current position and open up a new one with either a different expiration date, strike price, or both. So why would you like to roll? Maybe the market change, or maybe you need more time, or maybe you want to lock in the already gains that you make and you want to risk a little bit more. But in this case, you know that already you can take a profit. And at the same time, it's going to have a lower potential of the assignment. So you can see in this case, in this example, we would sell first. We would close the call at 91 cents and selling a new one for $2.5. So in this case, we would have a net credit. So yeah, the rolling out is placing the trade to push the expiration to a date further. So you can see that we moved in this case from 18 December 2020 to 15 January 2021 by doing this. So an investor would consider rolling out the short options if their outlooks has not changed and they want to take advantage of additional time. And also it's important to realize that by rolling out a trade, you are closing one trade and opening a new one. So be sure that it makes sense before doing it. At the same time, we can see another example of rolling down. In this case, the rolling up or down is placing a trade to either increase or decrease the strike price. An investor would consider rolling up a short option if their outlook has changed and they want to take advantage of the additional stock price movement. For example, we are closing one call at $4 and we are selling a new one for 87 cents. So in this case, we would have a net debit. How to manage the option at the expiration? Like I said previously, we can close the trade, exercise it, or if they expire worthless, we will do nothing. But yeah, even if it's 1 cent above the strike price, they are always going to be exercised. How do you close the trade? The same way you enter into one. So we are in the broker, and for example, we have a trade here, and we are going to submit. Like for example, we want in this case to buy this one. We submit it. In this case, we are going to make buy of this, for example, call, or what it is. Yeah. Well, then at the end, we are going to sell this call. Very, very self-explanatory. Now, how to manage a position? It's very important always to have a plan, but don't worry, in the advanced lesson I'm going to provide you from A to Z everything that you need, you know, for the plan and how to get started. But yeah, just to put some ideas, you have to reduce concentration in individual position sectors, like focused on one thing if you want. In this case, I like to trade the index itself, like the XPX or XPI or QQQ for Nasdaq. Keep it small and in proportion to your portfolio. One of the rules that I have on each entry that I enter never is more than 1% of the total capital, and the maximum that I am in a trade during a day is going to be 5%. Go into each trade with a mentality that you are going to be able and you are going to lose that trade. You know, it's a big possibility, so you have to understand it. And of course, you have to be flexible and adapt and change if the market change or your opinion has changed. So yeah, there we can see the review of the different type of rollings that you have. So yeah, thank you for watching and see you in the next lesson. Bye bye.